Investment at its deepest level has never been about numbers on a screen. It has always been about how humans attempt to secure the future in an uncertain world. When I trace the history of investment from land to tech stocks, I do not see a linear march toward sophistication, but a series of shifting beliefs about what is permanent, what is productive, and what can be trusted to outlive the investor. Every era invests in what it believes will endure, and when that belief breaks, capital moves sometimes violently toward the next promise of stability or growth. For most of recorded history, land was investment, not because it yielded the highest return, but because it represented control, survival, and legitimacy. In agrarian societies, land produced food taxes and soldiers. It could not disappear overnight. It anchored wealth to physical reality. Kings granted land to secure loyalty, nobles hoarded it to preserve status, and peasants dreamed of owning even a small plot to escape dependence. Investment here was inseparable from power. To own land was to own people's labor and the future harvest. Returns were slow, predictable, and deeply political. There were no markets in the modern sense, only hierarchies reinforced by property. As trade expanded in the medieval and early modern periods, capital began to seek mobility. Merchants discovered that ships' inventories and trade routes could outperform land if risk was managed. This was a psychological leap as much as a financial one. Investing in a voyage meant accepting uncertainty in exchange for outsized reward. Early investors diversified by spreading cargo across ships, inventing risk management before the language existed. Here, investment began to separate from physical permanence and attach itself to flows of goods, silver, and information. Wealth became something that could move, multiply, and vanish. The rise of joint stock companies marked one of history's most profound investment revolutions. For the first time, individuals could invest in enterprises larger than themselves without direct control. Shares in the Dutch VOC, or the British East India Company, represented claims not on land, but on future profits, extracted from trade and empire. This abstraction changed everything. Investment became scalable. Risk became divisible. Returns became disconnected from personal labor. But so did responsibility. Capital flowed toward ventures whose consequences were distant and often brutal. The logic of investment began to outrun the logic of morality. By the 18th and 19th centuries, government debt emerged as a new cornerstone of investment. Bonds offered something revolutionary: predictable returns, backed by the taxing power of the state. For investors traumatized by failed ventures and volatile trade, sovereign debt felt safe, rational, almost virtuous. Lending to governments funded wars, infrastructure, and empire-binding private wealth to public power. Investment was no longer merely a private act. It was a pillar of national finance. This period taught investors a lesson that still resonates. Safety is often political, not economic. Industrialization shifted the center of gravity again. Factories, railways, and machines demanded capital at unprecedented scale. Equity markets expanded beyond merchant elites, offering participation in industrial growth. Investing in railroads was not just about dividends. It was about believing in progress itself. Entire nations bet on steel tracks and steam engines. Bubbles formed, fortunes vanished, but the infrastructure remained. This revealed a recurring pattern. Speculative excess often finances real transformation. Investors lose money. Society gains capacity. History rarely remembers this trade-off kindly, but it repeats it relentlessly. The 20th century institutionalized investment. Pension funds, insurance companies, and mutual funds pooled savings and professionalized allocation. The individual investor receded as institutions rose. Stocks came to represent ownership in abstract, corporate entities, rather than tangible operations. After the Great Depression, regulation and disclosure attempted to civilize markets, while post-war growth rewarded patience. Equities gradually displaced land and bonds as the dominant long-term investment, not because they were safer, but because they captured productivity gains in expanding economies. Investment became a claim on growth itself. Late in the century, financialization accelerated this abstraction. Derivatives index funds and global capital flows detached investment further from place and production. Money chased returns across borders in milliseconds. Ownership became fractional, passive, and often unconscious. Investors no longer knew what they owned. They knew only performance. This distance reduced friction, but also weakened understanding. When crises arrived, they arrived as surprises, even though the risks had been accumulating in plain sight. History here whispers a warning. When investment becomes too abstract, belief replaces knowledge. The rise of technology stocks represents the latest chapter in this long evolution. Unlike land or factories, tech companies invest primarily in intangibles, code networks, data, and human capital. Their value lies not in what they own, but in what they can scale. Investors are no longer buying assets. They are buying optionality, future dominance, and narrative. This is why valuations feel untethered to traditional metrics. The asset is expectation itself. Tech investing revives an ancient pattern in modern form. Capital flows toward whatever promises permanence in a changing world. What distinguishes tech from earlier investment eras is speed. Feedback loops are faster. Capital concentrates quickly. Winners dominate globally. Losers vanish completely. This amplifies both returns and regret. It also deepens inequality between those with access to early investment and those without. Once again, history repeats new investment frontiers, reward proximity, information, and timing more than virtue or effort. Across this long arc, the history of investment reveals a simple but uncomfortable truth. Investors are not rewarded for predicting the future accurately, but for aligning with what their era believes the future will value. Land, trade, empire, industry, finance, technology, each rose when it felt inevitable, and each eventually disappointed those who mistook dominance for permanence. The skill of long-term investment has never been clairvoyance. It has been humility, diversification, and an awareness that every new era eventually becomes old. And it is here at the point where capital once again crowds into intangibles and narratives that the historical question sharpens, because investment is no longer about choosing assets alone, but about choosing which vision of the future you believe will survive contact with reality. And the story continues as the center of value shifts yet again from what can be owned to what can be scaled and defended in a world where technology moves faster than institutions. And belief itself becomes the most heavily traded asset of all as we turn the page toward that reality. Because history insists that every dominant investment form eventually confronts limits it was never designed to handle. As capital concentrates in technology and intangibles, investors discover that scale does not eliminate risk, it transforms it. Where land failed through war and expropriation, tech fails through regulation disruption and shifts in network behavior. Where factories decayed physically, platforms decay socially. Trust erodes. Users migrate. Governments intervene. The fragility is different, but no less real. What makes this moment distinct is not that investors are chasing growth, but that growth itself has become reflexive. Capital fuels expansion. Expansion validates valuation. Valuation attracts more capital. This loop feels familiar because it echoes earlier eras from railroads to dot-coms. Yet the underlying asset has changed. Today's investments often lack hard collateral. Their durability depends on dominance, attention, and political tolerance. History reminds us that these are unstable foundations. Power attracts scrutiny. Size invites constraint. The very success that draws investment also sows the conditions for its moderation. Over time, successful investors have always adapted by broadening their definition of value. When land dominated, wise capital held trade. When trade boomed, prudent wealth held bonds. When industry rose, portfolios diversified into equities. The lesson is not to reject new frontiers, but to contextualize them. No asset class remains supreme indefinitely. Each is a response to the problems of its era, and each becomes vulnerable when those problems change. Investing well historically has meant recognizing when yesterday's solution is becoming tomorrow's risk. The history of investment also reveals that returns are inseparable from social structure. Land rewarded those with status. Trade rewarded those with access. Industrial stocks rewarded those near capital markets. Tech rewards those near information and networks. This is why every investment era produces inequality alongside innovation. Capital compounds where it already resides. Over time, political pressure builds to redistribute, regulate, or redirect. Investors who ignore this dynamic mistake markets for machines rather than mirrors of society. As we move forward, the frontier of investment will likely continue shifting toward intangibles, data energy transitions, intellectual property, and systems resilience. But history cautions against believing that intangibility means invulnerability. The future will not eliminate cycles. It will express them differently. Valuation will still overshoot. Narratives will still outrun cash flows. Corrections will still arrive disguised as surprises. The language will change. The psychology will not. The enduring lesson from land to tech stocks is therefore not about picking the right asset, but about understanding the moment. Investment success has always depended on aligning with long-term forces while resisting short-term certainty. Those who survive multiple eras are rarely the boldest or the smartest. They are the most historically aware. They remember that permanence is an illusion markets sell at a premium, and that humility is the only asset that compounds across centuries. If this journey through the history of investment has reshaped how you think about markets and value, I invite you to subscribe and continue exploring these financial histories with me, and to leave a comment, sharing which investment era you believe most resembles today. Because history does not tell us where to invest, but it does tell us why we keep believing that this time will be different.